has the best tech team. Let's get started.
Have a great day.
See ya. All right. Without further delay here, because we're now 4 minutes late, just a quick disclosure here.
You're live.
I am an associated member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA SIPC. You should carefully consider whether trading is suitable for you in light of your own financial condition. And a quick position disclosure here. Despite some warning signs here for this market that I'll talk about in a minute here that are starting to make me a little bit nervous, it is still a bull market, and I am still very net long with just one little AMC short out there, which is I'm pretty light in that short position at this point, which that thing actually also broke down on a pattern today, which I can talk about today also. All right, let's hop into our afternoon meeting. So how did markets close today? SPYs are down a whopping 0.14%. Qs are basically flat here on the day, and the IWM is down 0.4%. So the IWM showing relative weakness. Today was a heck of a day. I mean, we had pretty big gap ups. You could see it from the SPYs. You could see it from the IWM, pretty big gap up here, followed by a really strong initial movement. And the NASDAQ initially was relatively weak. NASDAQ was initially relatively weak. It did gap up like the other indices, but sold off really quickly. All of this can really be attributed to the movement in the TLT. And then you could have a conversation about, you know, what we are attributing the movement in the TLT to. But the TLT was basically down pre-market. So that means that interest rates were up. Interest rates being higher, that is generally good for financials. It's generally good for your IWM, your small caps, your mid caps, and it's generally going to put a little bit of a damper onto tech. So if you look at the TLT price action here in the beginning of the day, again, we're down pre-market. We opened up down very small, stuck around flat, tried to break down a little bit. What did the Qs do at the same time? Qs sold off, while the IWM, the Russell, which gapped up, had a gap and go here with a beautiful initial move. It's interesting to see recently, not only, you know, there's always a little bit of a deviation between how the IWM and the NASDAQ is trading because they represent stocks that are, you know, pretty different in the marketplace. But we've been seeing recently, especially at the open, oftentimes they're moving like directly opposite of one another. And that's what we had today. We had the IWM off the open, 4 beautiful green momentum bars right away in a row on the 5-minute chart, with the NASDAQ here, the Qs having straight down momentum in the beginning of the day, filling the gap, and then at some point that started to flip. So you can see the TLT after 10 o'clock, like 10:05, 10:10, really broke into positive territory, got above yesterday's high, and then this move from 10 after 10 to the high at noon was pretty ferocious. This is a pretty big intraday move for TLT. We don't often see a TLT moving that big intraday. You can see just from the last couple of trading days, this is more typical, where it might gap in one direction or whatever, and then, you know, the price action is a little bit more sideways, a little bit more grindy. This was actually a really big move here. It could be related to fears over growth, fears over the Delta variant of the virus. You know, whatever it is, TLT is generally a safety play, right? Buying U.S. Treasuries is a safety play. So the market is buying Treasuries, they're selling off interest rates, and then that was causing a flip in relative strength and relative weakness. So you can see the IWM tops after a beautiful momentum move at about 9:45 this morning, and then just totally rolls over, breaks new lows on the day at 11 o'clock, whereas the Qs basically bottom at 9:50 and then, you know, work their way all the way higher, basically get back to near opening highs before not doing anything. And then really in the last hour of the trading session, we saw broad market weakness across the board in the NASDAQ. The SPYs here very weak, going to negative territory. SPYs were green basically all day today. And the IWM, you know, rolling over into the close as well. So I consider today to be a really disappointing trading day. I was actually really disappointed also on Thursday and Friday. As you know, you guys all know, I have been continuously looking for relative strength in the Russell, and I haven't gotten it. This goes back to, we called this bottom here as a team on July 19th pretty much perfectly. We recognized the extension in the IWM. We recognized an expected relative strength, and the only surprise on these couple of trading sessions was not that the market bounced, was not that the IWM showed relative strength. The only surprise was the degree of the up move and how fast it occurred. Within basically 2 trading sessions, we were going from 208.80 here in the IWM all the way back up to a high of 222.22. And then this 222 in the IWM has really established itself as resistance. So after a really big move in a short period of time, what you actually want to see is this price action, this consolidating price action. I actually was a little bit excited. I think this was Tuesday of last week when the IWM kind of had a false breakdown of this wedge that it was starting to build out, because that oftentimes leads to a move in the opposite direction. It's basically, for people who are trying to understand supply and demand in the market, which is what creates technical analysis, you can look at what happened with Bitcoin, right? That break of Bitcoin below 30,000 for a short period of time, breaks below 30,000, and then comes right back up. That's what I think enabled Bitcoin to become back in play and to work its way up to 40,000 plus. So this false breakdown of this wedge pattern that was building out in the Russell actually got me excited that I was going to be correct to see more relative strength come out in the IWM. And that is while big tech earnings were coming out. And even though big tech earnings, for the most part, except for with maybe Amazon, where the numbers were phenomenal out of Apple, Google, Microsoft, all I really wanted to see from these companies, despite their numbers being excellent, was them holding up, and not a repeat of what we saw last quarter at the end of April. Apple reported on April 29th, reported phenomenal numbers, gapped up, sold it off. Microsoft reported great numbers back on April 28th, and they didn't even gap it up. They just immediately gapped it down and sold it off, and that basically led to a correction in the NASDAQ at the end of April, kind of into mid-May. So all I wanted to see from tech, because we all know tech had this massive move from June into July, just really leading the market higher. All I wanted to see was big tech actually hold up, go sideways. I think that would be one of the most healthy things we could see from big tech as a whole right now, and that's exactly what we've been getting. We've been getting the Qs have kind of been building out this pattern here that's been going sideways. It's been 1, 2, 3, 4, 5, now 6 rest days in a row. I'm really happy with this price action, but what I wanted to see as the NASDAQ goes sideways, digests these phenomenal earnings reports, but again, they were after really big moves. I really wanted to see this relative strength come back into the reopening trades, value names, small caps, mid caps, some of those speculative stocks. We had that big list of speculative stocks that we look at, which include the marijuana companies, the 3D printing companies, a whole bunch of other speculative names, your Jumais, your Palantirs, your Plugs, your fuel cells. That's where I really wanted to see kind of strength come in. Energy, financials, all those names. And once again, for the 3rd day in a row here, and I'm starting to view this as a warning sign, almost for the 4th day in a row, we saw really strong early day price action in the Russell here. Thursday last week was kind of a grind higher with an intraday double top that led to a rollover. Then Friday last week we had beautiful opening momentum that just totally died at 10:15 and led to new lows on the day. And then same thing as Friday today, beautiful gap and go opening momentum, 4 excellent green bars in a row here. Find a healthy technical correction back to the 80 MA on the 5-minute, should lead to a higher high, does not. Lower high comes in with a little bit of a topping tail. Okay, maybe you got to build out a wedge, maybe it needs more time. You get to 10:15, 10:30, a lot of times your 15-minute chart starts becoming more important, so maybe you need a time correction or a price correction on a 15-minute chart. Nope, we didn't get any of that. We got the TLT starting to rally, and then subsequently the IWM giving weakness, and then this thing just rolls over, makes new lows, and is garbage. And now you look at the Russell here, we kind of have 3 topping tails in a row on the daily chart. 222 has been the big resistance that I keep talking about on a closing basis. We keep getting above but closing below. This is not good price action, and To me, it's almost becoming a little bit of a warning sign. I'm not ready to jump the gun on it because if you look at the SPYs, it is still a bull market in the SPYs. SPYs have also been time correcting for the second half of July and now the first day of August. If you look at the Qs, SPYs and Qs, we are without a doubt still in a bull market. Russell is neutral. Russell's in neutral territory here, which means that it's shortable and buyable, kind of depending upon the underlying relative strength, relative weakness, underlying setups that you see come in. But again, what I wanted to see, one of the hallmarks of 2021 as a year has been money rotation. It's been really the key to 2021. It's been whenever one index or one sector takes a break, money starts getting rotated to somewhere else. And right now we're seeing the break in tech, but what we're not seeing is the money rotation into the Russell. To me, that's a concern. To me, that's a warning sign. I don't like it. I don't like this TLT strength at this point. It was one thing when this was actually a destabilizing move in the TLT to the downside, going back to February and March. And what the market dislikes from interest rates right now more than anything is speed of movement, down or up. It wants it to be grindy. It wants it to kind of go sideways. It wants to be stable with interest rate numbers. But first, the market was getting scared here into mid-March, early mid-March, because interest rates were going up too fast, as represented by the speed in which the TLT went down. Then we saw here in mid-July, into this rally, that the market was getting nervous because TLT was going up too fast, meaning interest rates were going down too fast. That's what created the low here, this pivot low on the SPYs on high volume, that again, we as a team successfully called this out pretty much perfectly because the TLT was getting almost parabolic at that point. And then since then, I've seen exactly what I want to see from the TLT, which is kind of just consolidation. Technically, you could call this a wedge pattern, and you could say that that wedge pattern broke up. It got above 150. 150 is definitely a psychological number. Brant was providing us some information in the VTF earlier today about what he was reading with TLT 150, about how if TLT gets bid up above it, it starts representing kind of some fears over growth for our economy that could lead to negative impacts on the market. So we got to start paying attention to these things. TLT starts ripping again. That's actually, even though big picture it can create relative strength from the Nasdaq. If TLT really starts ripping, it can definitely have a destabilizing effect on the market. We got to pay attention to that. We got to pay attention to money rotation or the lack thereof. I do not like that this IWM has not been able to keep a bid as the Nasdaq has gone sideways and as the SPYs have gone sideways. I don't like that. We got to keep an eye on the VIX. VIX here caught a little bit of a bid into the close today, a little bit of a bid today. Okay, fine. Market sold off. VIX got bought up. There's nothing unusual about that. But one day is just one day of strength. Nothing to be overly concerned about. As a matter of fact, I still like VXX as a short trading vehicle just because of the time decay while it's easy to borrow for us. But these are just a bunch of things that are starting to become concerns under the surface. We got to pay attention to breadth. Breadth was one of the big problems in July, right? The Qs were ripping us higher, the FANG names were ripping us higher, but breadth had gotten really poor. I'm curious to know what the breadth numbers were today. So Gabriel here asking me, where is the money rotation going? Well, that's exactly what I'm saying. One of the warning signs I'm seeing right now is I'm not seeing that new money rotation constantly coming in. What created strength in this market for most of this year was constantly money rotating into something. It was rotating into energy and reopening and reflation trades. Then those took a break, but then tech started catching a bid. Now tech is taking a break. So what's catching the bid now? Where is the money rotation coming into, Gabriel? The answer is I don't see it. The only thing I see some money rotation coming into, which is also not what I want to see, is defensive names. Yeah, I guess Pepsi was a little bit red today, took a little bit of a break, but Procter & Gamble kind of held up just fine after reporting decent earnings the other day. Clorox, was able to be green today and was, holding up. Look what the market did in the last hour of the day today versus Clorox just holding up really well. So the only thing I'm seeing money kind of hold up in is like consumer staples, and that's from a trading perspective. It's really not what I want to see. I really don't like trading Coca-Cola and Pepsi. You know, they're really not the type of trading vehicles I want to be going to on a day-to-day basis. So again, these are just little red flags. Right now, S&P here is still a hair away from all-time highs. Qs are still a hair away from all-time highs. IWM, a little bit more neutral, a little bit more concerning. So while the SPYs and the Qs are holding up so well, we do still want to err on the side of the longs for the marketplace. You know, it's a much more forgiving mistake to be too long this market than too short this market. But yeah, Gabriel, I mean, even honestly, it's at some point in time, you know, like buying in big tech, like names like Apple and Microsoft, is also a little bit of a flight to safety because people are scared. Buying up the TLT is a flight to safety when people are scared. What did the dollar do today? And not too much. EUP, I guess, up a little bit, but that can also potentially be like a flight to safety type of trade. So we'll keep an eye on all those. You know, again, SPY price action, Q price action, a little bit boring. I would characterize the IWM price action as just straight disappointing. I really wanted to see, and I was talking to you guys about this on the radio in real time when it was happening, I really wanted to see, obviously this degree of movement is unsustainable from the first 20 minutes of the day, but after this price correction, I really wanted to see at least stabilization here in the IWM and a maintenance of that strength and a close above 222. I mean, we were at 224.50 today by, you know, 9:45. We were at 224.50 today in the IWM, and we still couldn't get a close above that key 222 level. So it's a concern. I'm not seeing the money rotation right now. I have all these concerns in the back of my head. So for me, it does mean that I still just want to be a little bit more cautious with this marketplace. I'm being much, much more selective right now on adding on new trades. I think you guys see that. It also doesn't mean I'm jumping to the short side of this market. It is still a bull market. I'm not ready to jump in short on too much except for your occasional one-off. It just means for me, take a half step back, take a breather. For me personally, I'm having a great year so far. You know, really good money for this year. My swing positions that I have, which are, you know, longs, are generally all very much in the money on all those positions, and that's fantastic. So for me, I'm just kind of mainly focused on position management. I got out of Hood today, Robinhood. Let's talk about this Robinhood for a second. So 38 bucks, we can definitely expect some resistance. Probably every Robinhooder who got, you know, stock on the IPO is probably sitting there on the offer at $38 because the media is telling them how bad of an IPO Robinhood was. I got news for you. This Robinhood was not bad of an IPO compared to a lot of IPOs that I've seen. This is not bad at all. I'll tell you who it wasn't good for. It wasn't good for the hedgies, right? The people that it's funny because, you know, I obviously follow Wall Street Bets in the community there just because you got to keep your ear to the ground and kind of know the pace of things and know what's going on. And, you know, they're all talking about Robinhood as like, this will be the first time the Wall Street Bets community wants to get short a stock, right? We're going to be like the hedgies and we're going to short Robinhood because we all hate Robinhood. Well, they're mistaken on this. The only thing that Robinhood was bad for was the people who are the traditional IPO flippers who are, you know, buying the stock at the IPO price from the, you know, the big investment banks because they do so much business with them, who are then, you know, selling them for 25 to 100% profits by the next day. You can only do that if you're a massive client of, you know, one of the big hedge funds. This thing was priced at $38. They opened it at $38, and all right, it sold off $5. You know, it sold off $4.50 to its absolute low. But so you're telling me that this is a less successful IPO than the one that is priced at $100 but opens up at $170 and then, you know, closes at $110 by the end of that week? No way. But the people on CNBC will be talking about how that's such a successful IPO because it, you know, closed at a 20% premium to the IPO price. But if you're just a regular person buying on the secondary market because you like the company, well, you just bought it at 160 and now it's closing at 120. You're screwed, and the only people who are making money are, you know, the clients of the big investment banks who were able to actually take advantage of it. I don't think that this Robinhood was bad at all. And honestly, the more that I've traded this, the more I've liked it. I've made money on all 3 days that this thing has been a public company to the long side. Each day, I made money on day 1, I made money on day 2, I made money, and I closed out my position on day 3 here to the long side. Got out into $38. $38 being the IPO price. Would definitely expect some resistance there, as some people who did get in at the IPO price at 38, were out of the money for a little while and might look to sell as soon as they're able to get break even, because that's kind of how money thinks. But Hood, I think, is definitely going to be something to keep on the radar. I really liked how it traded just as a trading vehicle, and we'll see how it's able to handle this $38. Other names today, before I get into questions from you guys, a couple other names that we had on our radar from the morning meeting today. One was the stock sell at 45. This was one of my ideas from today, and then I think one of you guys echoed this idea. I did like this $45 level a lot. One concern I had on the $45 buy and SOX L was 3 big up days in a row. But when you look at kind of the underlying stocks here, so normally I don't like buying a chart that's this extended. Stock is at $45. I guess it's technically a leveraged ETF. It's the 3X Bull ETF for the semiconductors. But the ETF here is at $45 with the 80 MA on the daily at like $42.50. So it's extended from our equilibrium area by $2.50. And a $45 stock. That's a lot on a percentage basis, keeping in mind that it is a levered ETF, so it's even easier for this thing to become more extended than a typical stock might. But the main reason for a lot of this extension was because of AMD post earnings. This move in AMD post earnings has just been absolutely mind-blowing and impressive. But if you look at a lot of the other semiconductor names, their charts look pretty good coming into today. This NVIDIA has really tightened up with a wedge pattern here that was potentially ready to break out. AMAT above 140, I think we spoke about in the morning meeting as well. I think it saw some option flow this morning. AMAT was trading really well in the beginning of the day today. Micron broke this kind of descending channel here, got above that, was looking decent. So yeah, AMD really extended, is maybe creating this SOX sell extended into $45. But when you look at some of the other underlying names that are big semiconductor names, they looked poised for continuation. So the thought process here was, even though the SOX L itself was extended, if you could get AMD to just rest and go sideways, let alone continue like it did, if you could get AMD just rest and digest these 3 big up days in a row, but you get some of these other names to actually start breaking out and start ripping, then this SOX sell could have acted as a really good trade here at $45. And guess what? It did act as a really solid opening drive trade if people were paying attention to it the second the market opened and went long versus $45. Though market weakness into the close eventually made this thing basically fail into the close. So great opening drive here. I know some people are looking at this intraday pattern here that broke up with not fantastic follow through. A little bit too much of a rollover here at noon, but the opening low is still intact. And then getting below $45 in the close, this basically just becomes something where you go, okay, this was a good trade. I tried it, but the market was very weak. This goes back to my overall kind of disappointment right now with the market that I touched upon earlier. But the market was really weak. This thing closing really weak. It is still extended on the daily chart, so I'm not swinging it. If this thing closed at 47, if it closed at highs and your price was 45.20 today, and you're buying this right off the open as kind of a breakaway gap above $45, you got excellent stock that you want to swing, rolling over into the close, it just means that you get out, and if you executed well and you game plan this well, you're getting out into the close with it being a profitable trade. So that's solid. Tesla was one of the ones that we saw a lot of option flow in today. With Tesla, and we saw a decent amount of option flow in SoFi as well. I just got filled on the offer in one of my positions. Give me a quick second. The thing about Tesla, $700, and I know a couple of you guys were talking about Tesla 700. The trade was to be in at 655. And obviously the Tesla 700 level breaking today honestly paid really well. You really could have gotten stock at $700 today versus the opening low of $698.40. So a $1.60 risk in Tesla is actually really good for this name. and that $1.60 worth of risk would have given you a move that was like $25 plus worth of reward at its highs. That's really solid. And then we were just seeing the big confirmation factor was the continuous option flow that was coming in. It just, the way the option flow was coming into Tesla today, it reminded me of this move back here. The move second half of November through December into the beginning of January. I just remember seeing, like, it seemed like almost every day there was like massive bullish option flow that was coming in that was just jerking the stock higher and just giving like a really sick move. It really reminded me of that. And we do know this is a momentum name. Momentum names can be extended and still give continuation. I still, as a rule, do not like buying stocks that are too extended. So for me, the $700 buy today was a struggle. With the ADMA, it's 674, below 674. So you're looking at this thing, you're buying it at $700, and it's over $25 extended from the ADMA, from that upper band of equilibrium, and that was right after. This was one of our ideas of the day for Thursday morning on the inside day and up off of the wedge break. And I think it also caught an upgrade. Beautiful bull wedge that's been built out now in Tesla, which is a company, by the way, which I really don't like. Sorry if I offend anybody with that. I'm not a huge fan of Tesla, but the technicals don't lie. Beautiful bull wedge that got built out basically over the entirety of 2021 that tightened perfectly to an inside down Wednesday last week with a high of 655, and then I think on the 29th here, on Thursday, was the day that Deutsche Bank upgraded it. This was like the perfect situation where a whole ton of those layers of probability that we're constantly talking about came together. You had the daily chart pattern with the combination of the inside day at the end, with the relative strength, with the option flow coming in, with the opening momentum coming in, with the volume confirmation at the beginning of the day, with the upgrade coming in, so it put it in play. It was like everything kind of came together for that 655 buy on Thursday. So it's very hard for me to be buying this thing at 700 after we had the 655 buy on Thursday morning as part of our opening game plan that day, when it wasn't extended at all, and now it's extended. The stock just being extended doesn't mean it can't work. It just means that you have a lower probability of success, right? But still, I know some of you guys were looking at that, and if you took that trade, congratulations. The option flow there, I think, was definitely the confirmation on that. I think that's all I've got for you guys today. So, with that said, I am happy to review any questions that you guys have. So let me check the chat here on the virtual trading floor. From Mike Z, what would have to happen for you to move to a net short position? The market technicals have to change. The big thing is we are seeing right now like some red flags, but guess what? It's not the first time we've seen red flags in this way up. And sometimes those red flags have led to really solid price corrections that we've captured. Sometimes it's been a signal for me to put shorts on even while I maintain my longs. But for me to actually really get net short the marketplace, there has to be a bigger technical event. There has to be a bigger technical signal. And for me to get out of my like I might start shorting positions if we get that bigger technical signal and not just red flags. But it doesn't mean that I'm going to rush out to get out of my longs necessarily either. I would just start taking more short trades probably at the same time. And then eventually what happens, so for me to go from net short to net long, so I guess to take a half step back, everything I do starts from the big picture, works its way down to the small picture. And as you guys know, I'm a big believer in win-win situations. Put yourself in the win-win situation, get your risk covered, be in the money, and then be greedy to really try to maximize your reward. That's what I'm looking for. My swing positions are basically all long except for AMC, and they're basically all win-win situations. So I have a game plan in place for should these positions start going against me on how I would get out of them to protect profit or to potentially move on from those stocks. That would happen probably after I started doing some shorting in the marketplace on certain other stocks because I got more technical signals. So basically what has to happen for me to go from net long to net short is not only does this bull market have to end, but my game plan to liquidate my longs has to be coming into place as I put short trades on. So I'm getting heavier to the short side because the short trades are manifesting themselves, and I'm slowly reducing exposure on long positions as per my game plan for these swing positions. Some of these swing positions I've been in for literally all of 2021. So it's gonna take time for me to unwind those. So basically, you get a really bearish market that gets me to start to piece out of them. The only thing that could get me to, like, on a dime, totally flip myself and just liquidate long positions and put short positions on would have to be like a major event. Like a major event like the original coronavirus. I don't see the Delta variant as that. A major event like a nuclear disaster hits or something like that, then I would potentially more on a dime just liquidate all my long positions and start looking at short positions if I felt that event was major. But if it's just like that the market starts getting really weak or starts rolling over as a result of, actions from the Fed that cause the trend to change, and it's not like a major one-time event, then it would just be like more of a slow process where, I start to liquidate long positions as I give back profit in them, and potentially start to implement short positions as I get technical signals for short positions. But look at the SPYs, look at the Qs. Tell me where the technical short signal is in those indices. It's not there at this time. These are technically bullish consolidations with some red flags under the surface. So that is Mike's question here. Next here from Robert, regarding Square today. If I was reading the news correctly, I understand that Square will be paying Afterpay $29 billion in stock. Should that mean that the price of Square should go lower today because they are giving $29 billion worth of their stock, or am I reading something wrong? So it's a great question, Robert. So Square was one that I wanted to stay away from. To move in this Square, sick. Let's look at the price action pre-market. Pre-market, you read the news, you look at Square, you can see here, 4 a.m., a little after 4 a.m., it's at, 233. The market opens up, it's at 280 at highs. It's a $50 move from the pre-market lows to the intraday highs in Square today. It is a massive, massive move. I don't like trading M&A. It is not my area of expertise. It is not my specialty by any means. The market basically has to figure out, and this is where I don't feel like I have an advantage, if the value of what Square is paying for that stock or paying for that company is worth more than what they're actually paying. Basically, is this going to help Square's growth? Is it going to help their earnings? Is it going to help their revenue growth by more than the amount that they're paying for it based on those deal terms? And again, this is definitely not my area of expertise. So for me, and it also was trading on earnings today, so that was also an extra X factor, all coming in together at once. There's just too many factors going on there for me to be able to really have a fundamental take on this. It's outside of my realm of expertise. I really just want to be trading the price action, or not trading at all, which is what I really chose to do. I didn't even have Square on my radar today, despite everything that was going on with it. It was down pre-market, then very quickly was having a massive upside move. So for me, this was just one that I went away from. You will see sometimes on these M&A plays, like Amazon, when Amazon bought out Whole Foods, as an example, within a very short period of time, like sometimes you'll see, and this is what happened in this case, the market cap of the acquirer, Amazon, or in this case Square, goes up by more than the amount in which they bought the company for. In which case it's almost like they bought it for free, right? That's definitely what happened when Amazon bought Whole Foods. I don't know. I'd be curious to know what Square's market cap change was today. How much of the Square purchase was just paid for by an increase in market cap today. I don't really know. So question part of your question, Robert, is about float. I don't really know how it affects the float of Square, so I really can't provide you any information on that. Gabriel's questions I already answered. Jerry's saying Pfizer. Oh yeah, Pfizer was another one of our ideas from the morning meeting today. Forgot about this. Yeah, so the Pfizer breakaway gap on the bull flag. This was also a beautiful trade today. This is another stock that's kind of in its own world. The inside day and up from the bull flag was about 43.20 or so. It gapped up above that, so you could have been buying this thing anywhere in this opening bar versus 43.20 as your stop loss, or very quickly using the opening out. I think Brant, you were involved in this one, right? If you were still here, great job, great call out from, I think it was Brant's idea in the morning meeting, and I'm not sure. So great idea from the morning meeting. Awesome teamwork on this. Great communication. Beautiful follow through. Amazing trade. Again, I love how here as a team we've been able to so consistently, even on the more difficult market days like today, find those gems in the rough of a couple names that are in play or have the right chart set up to kind of continue to pay us even on what is otherwise a difficult day. So that's awesome there. Yeah, thanks for bringing that one back up, Jerry. David asking about Facebook short. To me, honestly, Facebook looks neutral. I dislike the company. I think everyone knows that. But from a technical perspective, definitely relatively weak today. But it's right back into all of this kind of price congestion here. So for me, Facebook looks neutral in a bullish NASDAQ. So I don't like doing a whole ton of short selling in a bullish market. You generally it's hard money. The easier money tends to be to the long side. So yeah, you definitely could have made a couple bucks short Facebook today if that was your focus. It was definitely relatively weak compared to the market, compared to tech. Went red very quick and couldn't recover even when the Qs did. Down 1% on the quarter and a quarter on the day, but not really the trade that I'm looking for. You may have some support here around 350 as you get into a gap fill. Gabriel asking a question here. When would you recommend holding a little bit more than 1% in the money on a trade, or do you not? Also for trailing stop overnight, once it opens, do you place the stop at yesterday's low? Okay, so great couple of questions here from Gabriel that I can kind of clarify his question. So the first part of his question is about holding a position if you're not at least 1% in the money. So for people who aren't aware, I have a general rule. It's a general rule. It's called the 1% rule. And this is a rule for keeping positions overnight and incurring overnight risk. So as I mentioned very briefly earlier today, I'm a big believer in putting yourself into what I call win-win situations with your trading. What is a win-win situation? A win-win situation is you put your risk on in the trade and it goes up enough so that your risk is covered and your worst case scenario is zero. Once you have a trade on and your worst case scenario on that trade, barring a crazy overnight event, but right now I'm still talking intraday. Once your worst case scenario on, let's just call it a day trade, is that you will lose zero, you are in what I call a win-win situation. So trading is about minimizing risk and maximizing reward. So when I am first entering a trade, I am looking to very quickly cover my risk, sell a percentage of my position to make sure that my risk is covered, so that my worst case scenario is if this thing comes down and stops me out, I lose nothing. Now I'm in a win-win situation. I'm either going to make money or I'm going to make a lot of money on the trade. Now we're approaching 4 o'clock. I still have my position. My trade's been working great. I'm in that Pfizer idea from today or whatever, and it's closing really well. Well, maybe I started this as a day trade, but maybe I want to keep some of this overnight. Why? Because I'm in a win-win situation, and sometimes to really maximize reward, you got to keep positions overnight. Your risk reward is always limited if you only keep positions intraday. If you keep positions overnight, if you are long a stock overnight, what is your hypothetical reward? Your hypothetical reward is infinite, because there's no way to know. Amazon was once like a $2 stock, right? Like after the tech bubble burst, and now look at Amazon. What are the odds that your day trade is turning into the next Amazon at $2? very, very low, right? But I've had stocks personally where I've made hundreds of percents over the time by being in win-win situations and choosing to keep them overnight. But there is risk in keeping positions overnight. You never know what's going to happen when the market is closed. A nuclear bomb could go off in some part of the world and the whole market gaps down 10+%. Your stock could announce some really bad news overnight that was unexpected. You know, not an earnings report, right? An earnings report is different. You know the earnings report's coming, and you're just gambling if you're holding your position into the earnings report. But for the most part, anything can happen. So the 1% rule is I want to be at least 1% in the money on an intraday basis to keep a position overnight, so that if something bad happens overnight, let's say that the position closes, I'm 2% in the money, plus I booked a whole bunch of profit. So really your profit cushion on it is even more than 2%. Because you booked a whole bunch on an intraday basis and you're still keeping a percentage of your position. It's closing 2% in the money from where you bought it, not from yesterday's close. It's closing 2% in the money from where you bought it. And now maybe the whole market gap's down 3% tomorrow. It's a big gap down tomorrow. 3% is pretty solid. And your stock is also gapping down 3%. Are you in a bad spot? No, you're not in a bad spot because you're in a win-win situation. You closed at 2% in the money. It's gapping down 3%. So you're down some money, but you also booked some of your position yesterday, so you booked even more on it. Maybe at this point with a 3% gap down, which is a really large gap down, you are now at break even in it. It's a win-win situation. But maybe the flip side of that is you are now in a stock that just continues to trend higher and trend higher and trend higher and trend higher, and you know your risk reward just becomes astronomically large because you kept the position overnight. So that's when I really want to be swinging positions. And for some stocks, 1% is not enough. You know, for some of these more volatile, speculative type names like SoFi or Palantir or Plug or a marijuana name or whatever, 1% might not be enough. So you need to assess the volatility of that stock. Maybe 1% is not enough for this name. Maybe it should be more like 2 or 3% in order for you to keep it overnight. The idea is to put yourself in a win-win situation so that if everything gaps down tomorrow, you're not in a bad spot. You just gave back open profit. So the question again was, do I ever keep a position if I'm not 1% in the money? I do, but I don't ever really want to do it with size. For me, I'll sometimes do it if it's more of like a feeler type trade for me, where you know sometimes I will enter a position and I'm using a daily stop, but I'm not very heavy in that position. I'm willing to give this a lot of room, and then okay, fine, I might keep this if it's only flat on the day, or I might keep if it's against me a little bit. For the most part, though, even in those situations where if it's a feeler, if it's closing against you on the first day that you bought it, you're generally going to be better off just selling that position in the close and looking to rebuy it the next day. Even if it gaps up and it means that you are potentially buying a little bit of a worser price, it's okay because then you didn't endure the overnight risk. So for the most part, you know, you really want to have that cushion. And then for the second part of your question, do I then, if I kept it overnight, do I put my stop in right away at 9:30 as soon as the market opens? I don't actually. I put my stops in for my swing positions at 9:45. I have what I call a 15-minute rule. And that's because if a stock gaps down a lot, sometimes you'll see panic selling. We know that panic selling in the beginning of the day usually lasts for about 15 minutes. So I have in my career, you know, one of the worst situations that could happen, and it's happened to me many times, is that a stock gaps past, you're out. Gaps past where your stop loss was supposed to be. And now you're like, oh my God, I thought I was gonna get out of $50, now it's gapping to $49.70, I'm gonna lose all this extra money that I didn't game plan for. Well, again, first of all, that's the risk of holding a position overnight. That's why the 1% rule is in place. But then again, if it's that really big gap down, it's gapping past where your stop loss should be, I use this 15-minute rule. Because in case that panic selling comes in, whatever the low is after 15 minutes, that's where my stop loss goes in, and it saved my butt a bunch of times actually having that rule. Next here from AJ, can you please go over how to build a position given the ups and downs of the market? Do you add the whole in one shot and ride out the down days? Whoa, none of this riding out the down days. That's not what we're looking to do. But as far as getting into a position, it really depends on the type of trade. Certain types of trades are going to be trades that I will build into more. I'm trading off a daily support level or something like that. Other types of trades, I'm taking all my stock all at once, like a momentum trade, a breakout trade. Generally, those types of trades, I'm taking all my stock all at once. I'm having one entry, buy high to sell higher. It's a momentum trade, and then my stop loss is in. And there is none of this riding out down days. We have stop losses, especially if you're trading on, with a professional trading account with T3 Trading Group, and you've got, really large amounts of leverage and capital access that the company is providing. Riding out down days could mean blowing up your account. So we're trying to keep that risk minimal. You ride out down days when you're in the money. You're 15% in the money on a position, and you ride out a 5% pullback on that position because you're implementing a daily or a weekly chart trailing stop loss, something like that, then fine. That goes back to being in a win-win situation, risking money to make money. But we're not holding losers against us and enduring down days on positions that are already against us. That is not how you set yourself up for success. So I hope that helps. Next here from TJ. TJ asking me about pins. Does pins recapture 60 today? No, yeah, that's kind of what I thought might happen with this thing. What is the correlation between analyst ratings versus price action? Okay, so we could talk about analysts here for a little bit and why I think analysts are jokers. Pin still has a great rating in the mid to high 60s. No one cares. And great fundamentals. I would be arguing against fundamentals based on that last earnings report, which analysts tend to echo. However, the monthly active users hit the price because it's all these stocks care about is monthly active users. These companies are not about their profitability. They're about their growth. And if they don't have the monthly active users, they crush them. And that's what happened here. Do analyst ratings tend to matter as traders? No. Should we be focusing on when it changes the current momentum? Asking for swing type of perspective. Yeah, so, I get into this sometimes. We can chat about it a little bit here today. For me, the biggest joker position on all of Wall Street is the sell-side analyst. I don't give a you-know-what about what any sell-side analyst has to say about a company or what their price target is or anything. I remember back when I was in college, young in college, trying to learn on my own about trading and investing. And this is pre-financial crisis. Actually, this is right before the financial crisis hit. And I was trying to do research on which stocks I should buy, which companies I should invest in. And one of the things I did was I just looked at a whole bunch of companies, and I looked at where the stock was currently trading versus where the average analyst said that the stock was going to go. And I just bought a handful of the ones that had the most amount of difference between where it was trading and where these analysts said it should have been trading. Guess what I bought? I bought Bank of America. I think I might have bought Lehman Brothers. Morgan Stanley. I definitely bought Bank of America. I don't specifically remember which ones. And then look what happened. We do not care what sell-side analysts think. Why? Because they don't move money. They're not managing money, right? What I care about, and this is the same thing when it comes to earnings reports, when they miss or beat expectations. What are they missing? Like, whose expectations? It's the average sell-side analyst. Well, who cares what the average sell-side analyst thinks? I certainly don't. I want to know what the expectations are of the top 5 active managers who own this company on that earnings report. Because it's probably not the same expectation as the average sell-side analyst. And that's basically it. So, and the biggest holders of actively managed funds, they're not going to tell me what their expectations are. So that is why you'll see in earnings reports, you'll see the company beat on earnings, beat on EPS, guide above expectations, sell up all day. You'll see the company miss on earnings, miss on revenue, guide poorly, go up all day. because that's not what matters. And it's the same thing with analyst upgrades and downgrades. I pay attention to every analyst upgrade and downgrade strictly because the change in event tends to put the stock in play, and we care about stocks in play. But after the actual event occurs, by 24 hours, by the next day, after a new upgrade or downgrade occurred, I do not care that this analyst has it at this price. And what we're going to see all the time, I'm surprised we haven't seen it yet in pins, what you see all the time from these analysts, because their incentives are perverse. Again, I've been saying this, been using this quote a lot recently in our meetings. One of my favorite quotes in finance comes from Charlie Munger when he says, "The older I get, the more I realize incentives are what actually drives everything." What is the number one incentive of a sell-side Wall Street analyst? It is not to make you or me money. It is not to provide information that's going to make you and me money. The number one incentive of an analyst is to provide information that is correct based on how the stock moves, so that they can keep their job. That's the number one motivation of any analyst that exists. This is why we see analysts chase price action all the time. How many times have you guys seen over the years of the VTF here that the stock goes up 5 days in a row and then it gets 3 analyst upgrades? We predict the beautiful breakout on the daily chart. 3 days later, after the huge move comes in, all the upgrades come in. Or also, after the earnings report comes, the earnings report's garbage, the stock gets destroyed, then all the downgrades come in. And I'm actually surprised we haven't started to see downgrades start hitting pins now, because that's when they do it. They chase the price action. So I could care less what any of those analysts have to say. As a matter of fact, if you are a trader and you've got friends who are analysts, you should look down upon them as lesser people in finance. Because tell them to start moving some money. Tell them to start trading for a living and pressing buttons and see if they can actually take all the research that they do as analysts and actually even make money off of it themselves. Because if they could probably make significantly more money than what JP Morgan or whoever is paying them to actually do their research, if their research was that good. But they're not. They're not doing that. They're not managing their own money based on their research because they're not good enough to be able to do it. And again, their incentives are all perverse. So, you don't want to just look at pins having a, $80 price target by the average analyst and use that as a crutch to hope that this stock is going to bounce back up. You got to analyze the price action on it. And the price action in this pins, this thing needs to get back above 60. I did not look at this thing at all today, but I looked at it on Friday morning when it was trading on earnings. You can see these tails here. Every time this thing would come up above 60, some seller, some big institutional seller was just hammering the stock back down. Whether it's a short seller or a long seller, I have no idea, but you need this thing to get above 60 and clear above 60 in order for it to start looking good again. So that is pins. Starting to run out of time here, gang. I'll scroll through here to see if there's any more questions. Yeah, Gabriel just giving me a little follow-up on the Palantir. So you swung your Palantir position because you were enough in the money on it, but today you're lesser in the money because it pulled back. Yeah, so the other side, though, is once I commit to holding a swing position, I commit to the game plan of that swing position, which usually means keeping it versus that out. And that's one of the things that is my least favorite thing on swing positions, and this will happen once in a while, is let's say you're in this stock from $50.20. Your stop loss is at $50. Stock goes to 53, and now it comes all the way back down, and now it's at $53. It's at $50.20. So you only have a 20-cent cushion between where your stop loss is, but it never actually triggers your stop. And now you're swinging the position overnight, and you don't have the profit cushion anymore. That's a very difficult situation because I feel like you need to stick to your game plan. Your game plan was stop loss of $50, but I'm very nervous now that this thing could easily gap past my stop loss because I don't have that same profit cushion. Yeah, Lehman Brothers Lehman Brothers did not work out. No, luckily I never had a position in Enron. Jorge letting us know that Lehman Brothers was rated as AAA the day before it went down. Yeah, absolutely. No problem, AJ. Happy to help out, guys. All right, gang. Let's end the afternoon meeting today because it's a little bit after 5 o'clock. I did have someone email me some really good questions today that I want to get into at some point in an afternoon meeting, but we'll save that for later this week. So you guys have a great night. I will see you all tomorrow morning. Tomorrow morning, 9 a.m. morning meeting. See you all then.
Did you stop XSplit?
I should have. Can you check to see if the video stopped running? It should be stopped.
Oh, but it's a little delayed.
See you. Take it easy.
So, no, you're still.
Can you hear us? Oh, maybe I gotta actually turn it off in XSplit.
Yeah, you do.
Oh.
So that you.